Origins of the Phillips Curve. In 1958, A.W. Phillips observed a relationship between wage growth and unemployment in the UK from 1861 to 1913. He found that when unemployment was low, wages rose quickly, and when unemployment was high, wage growth slowed. This was a groundbreaking finding at the time because it suggested a stable, inverse relationship between inflation and unemployment. Economists used this insight to predict short-run economic dynamics. The interpretation was straightforward. Low unemployment signified strong aggregate demand, which pushed wages and, by extension, prices higher. When unemployment was high, aggregate demand was weak, leading to slower wage growth and lower inflation. The Phillips Curve explained. So, what does the Phillips Curve tell us? It illustrates the short-run trade-off between inflation and unemployment. Here's how it works. When aggregate demand increases, firms expand production and hire more workers, reducing unemployment. However, this increased demand also drives up prices, leading to higher inflation. This trade-off is depicted graphically as a downward-sloping curve. The greater the aggregate demand, the higher the inflation and the lower the unemployment. Conversely, weaker aggregate demand leads to lower inflation but higher unemployment. The Phillips curve and aggregate demand, AD, and aggregate supply, AS. Let's connect this to the aggregate demand, AD, and aggregate supply, AS framework. The Phillips curve captures the short-run combinations of unemployment and inflation that arise as shifts in the AD curve move the economy along the short-run AS curve. When AD increases, 1. The economy's output rises. 2. Unemployment falls. 3. Prices increase, leading to inflation. In essence, the Phillips curve reflects the interplay between AD, AS, and macroeconomic objectives. Historical significance of the Phillips curve. Economists were initially thrilled by the stability of the Phillips curve, which held from 1861 to 1957. The interpretation was simple. Unemployment served as a proxy for aggregate demand. Lower unemployment meant higher aggregate demand, driving wage growth and inflation. For decades, the Phillips curve was a reliable tool for understanding short-run trade-offs between inflation and unemployment. Limitations and breakdown of the Phillips curve. However, the relationship depicted by the Phillips curve began to unravel in the 1970s. Why? Two major factors disrupted its stability. 1. The oil price shocks of the 1970s. These increased firms' costs, leading to higher inflation despite rising unemployment, a phenomenon known as stagflation. 2. Changes in how workers and firms formed inflation expectations. Before 1960, inflation fluctuated around zero, so wage setters assumed stable prices. But after the 1960s, inflation became persistently positive. Wage setters started anticipating higher inflation, which altered the trade-off between inflation and unemployment. Inflation-augmented Phillips curve. This failure gave rise to the inflation-augmented Phillips curve, which incorporates inflation expectations. The revised model shows that inflation depends not only on unemployment, but also on how workers and firms expect prices to change. For example, if workers expect inflation to be high, they demand higher wages. Firms pass these costs on to consumers as higher prices. This feedback loop weakens the original Phillips curve's predictive power. Mathematical representation of the Phillips curve. Now, let's formalize the Phillips curve mathematically. Pi equals negative h times the difference between u and un, where pi represents inflation, u is the unemployment rate, UN is the natural rate of unemployment. H is a positive constant. This equation shows that inflation is negatively related to deviations of unemployment from its natural rate. If unemployment falls below the natural rate, inflation increases. Evidence. United States. Does the Phillips curve hold in practice? Let's look at the U.S. data. Before 1970, the trade-off between inflation and unemployment was clear. A steady decline in unemployment during the 1960s corresponded to rising inflation. However, after 1970, the relationship broke down due to the factors we discussed earlier, like oil shocks and changing expectations. Empirical evidence. Germany. In Germany, a similar pattern emerged. From 1959 to 1970, the Phillips Curve depicted a stable trade-off. But after the 1970s, stagflation and changing expectations disrupted the relationship. These examples highlight that while the Phillips Curve can explain short-run dynamics, it's less reliable over the long run.